Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, April the 6th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. A little bit of economic data coming out today. Across the pond, we got German factory orders coming in line with expectations at 3.4%, was expected to be 3.4%. And then we also got European retail PMI came in at 49.5. Again, this month lower than that 50, which is showing a bit of contraction. And then here in the United States, we've gotten our building permits came in at negative 2.5%, and it was expected to be a increase of 1.4%. So keep that in mind. One thing though, that being a pullback, building permits, you can't build without pulling permits. Usually I say you can pull as many permits as you want, but it doesn't necessarily mean that you are going to build. But when you aren't pulling permits, that means you're not expecting to build. But on the flip side of that, if we look back at last month's number, that was revised up to 5.8%. So I think that those really kind of balance each other out. And then we got unemployment claims came in at 234,000. It was expected to be 251,000. That number being lower than expected is a good sign because less people claiming unemployment. Then on to natural gas storage was a build of 2 billion cubic feet, was expected to be a build of 10 billion cubic feet. So not quite as much of a build as was expected. We also had overnight basically Mario Draghi, early morning Mario Draghi speaking at like 3 a.m. So early morning. Anyway, on to the overall markets. Crude oil, short-term memory loss. They forgot about the build that we saw yesterday and pushing up above that value area high. Yesterday, late in the day, really started pulling back and the equities kind of caught up with crude oil. Remember, I always talk about crude oil is going to kind of be the levers and pulleys a lot of times. And if crude oil is down, the equity market not necessarily meaning that it should go up. I don't really think that there is a total correlation there necessarily. We're seeing a big build. We're not seeing demand necessarily, which should kind of put a wet blanket on the equities. But at the end of the day, when they're pumping out this much oil, it really shouldn't necessarily correlate so much in that regard. Anyway, on to the overall markets. We got gold again. Started out in positive territory and is starting to slump off. Got back above that 9-day moving average. Remember yesterday during the market commentary, it was below that, but the equities were up. Equities fell out of bed heading into the close yesterday, so that gave a boost to gold and the bonds. Bonds pushed higher yesterday as well on that big sell-off, but the bonds today are down just slightly for the most part, but stuck right there again at the point of control, which is where the most time and volume has been spent. The market really has priced in the increased interest rates going forward unless the Fed does something wanky and says that they're going to maybe move at a 50 basis point click. But I don't think that we're seeing that much robustness. We're not seeing that much inflation. So they could just steadily move it up to about a 1.25% by the end of the year, which is what I predicted at the beginning of the year. If you remember, actually at the end of last year for my 2017 predictions. Anyway, the Dow Jones Industrial Average up 48, almost 50 points and above that 9-day moving average yesterday. Remember, we were well above that. Market was just very close to the highs of the day when that sell-off happened. And it was just like somebody pulled the rug out from underneath the equity markets and they just fell. Then on to NASDAQ, up 10 points on the day. not really even retracing half of yesterday's loss, but at the end of the day, it is up on the day after making a historical high yesterday. Then we have the E-mini S&Ps, basically recapturing most of yesterday's loss. Again, they were up pretty nicely yesterday heading into the close. We'll see what happens here on the 30-minute chart. And this is, like I said, a 30-minute chart of the E-mini S&Ps. And as you can see here, the overall market just really fell out of bed heading into the close. 11 o'clock time frame is where it started here, which is basically 1 o'clock Eastern. So for the next 3 hours, it was like an unabated sell-off to the downside. So the market really just lost all steam whatsoever yesterday. But today, maybe could be basically the short covering happening, because it really just sold off right into the day, and a lot of people probably went home short today looking to cover. On to what I've done. Basically, in craft, if you remember, I did this for the poor man's covered call strategy. And the reason why I love this strategy is because you don't have to have as much margin as you would to go out and buy a $72 stock, 100 or 200 times. That's a lot of money. Not a lot of people have, a $250,000 margin account. So in that, if you don't have a $250,000 margin account, you probably shouldn't be doing a 200 or 300 lot in a stock like this. But with a quarter of that kind of money, you could be trading this as a poor man's covered put. Of course, you don't get the dividends and things of that nature, but you still get to participate on the upside if the market starts rallying. Kellogg hasn't worked out that well. It has sold off, but I continue to sell my calls against it, lowering my basis, which overall increases my probability of profit with this. So I started out with the Jan-March in this strategy and paid around $16. So my break even is going to be right around $76. So you can imagine I've lost a little bit on that side because I'm long the 60 calls, paid $16 for it, and that would make my break even $76. But because I've been able to continue to roll these calls out in time, I rolled the March into the April, and now the April into the May, and have collected a little bit better than $1 on that, about $1.10 for those rolls on selling those calls. That's lowered my break even to around $75. Now, albeit it is a loser right now, it is continuing to be mechanical and waiting for a pop up to right basically where the point of control is where my break even is. So that is where the most time and volume has been spent. That's where it's going to be comfortable. So I'm looking for that kind of move to happen. Hopefully they get nice earnings coming out here in the May. In May. So if we can get that to happen, then get a little bit of a pop, that'll be pretty nice. So continuing to stay mechanical with that and rolling that out in time. If you are following along on that trade, that's kind of how that's working out. Now with Macy's, ticker symbol M, I'm looking to cover this trade. If you remember, I have some short puts on in there, and I'm looking to cover those. I have the April 28.5 puts on, and I'm short those. Sold them at about about 50 cents, trying to get out of it for 50% of my profit on that, which is 25 cents. So I've got a working order in there. It was a little bit closer earlier on this morning. We're starting to see that bit of a sell-off, so it's getting a little bit away from me, but I'm not going to really chase it. So I'm just going to give that as a working order. Then on to Target as well. Remember, I just put this Target trade on with the big move today up in Target. We're getting a little bit of volatility crush. I might be able to cover that for around 50 cents, 50% of my max profit. I sold it for, I think it was around 27, 28 cents, and looking to try and cover that today for about 16 cents. Not quite 50% of my max profit, but in just a day, I'm looking to cover that trade if I get the opportunity. So I have a working order in that as well. It's probably right now 6-7 cents away from me. Get any more move to the upside, I might be able to get that one too. So still continuing to be mechanical, working those orders. Friday, we are tomorrow going to be starting our earnings season trade. So these are trades that I love, get you in the market. We're able to take advantage of volatility crush. As you can see, anytime we lead into the earnings, we start getting this volatility expansion, which makes it perfect timing. We know we're going to get volatility crush. Any other time when we're trying to sell volatility, other than earnings, we don't necessarily know whether or not we're going to get that volatility crush. Volatility could expand, but the 99% of the time, as you can see, after that earnings, we get some volatility crush happening. Boom, boom, boom. And in that, we could be directionally wrong or directionally right, but that volatility crush is going to help us. So if we're directionally wrong, we could still have the possibility of making money. All right. So go to protraderstrategies.com, sign up for this series on earnings, and I hope we can see you guys all there. Like I said, it's going to be a 4-part series. Some great strategies in there. Show you my favorite ones that I like to do. And that's about all I got for you guys today. Other than if you can't take that, take it easy.